So today we're going to be talking about a higher time frame analysis, right? Because the very first thing I do whenever I open my graph is I always go to my higher time frame. I always go to my higher time frame to number one, check my bias and get my bias on the market. And number two, to confirm whether any trade I'm taking is not going above a particular level or below a particular level, right? But the most important thing is that I always use my higher time frame analysis to confirm my bias. So before I go into details about that, I want us to talk about what I generally check on the higher time frame, right? So when I go to my higher time frame, especially the 4 hours and the daily time frame. So when I go to the 4 hour or the daily time frame, the first thing I check is I check for the market structure. And when I talk about market structure, you need to know that the market has always three main types of structures, right? You either have an uptrend, a downtrend, or a range. So you either have an uptrend like this, something like this. So you either have an uptrend, a downtrend, you have something like this, or you have a range. And a range is simply a market in which the market is not going up and the market is not going down. So the range is simply a market in which price is stuck between two levels of price, right? Price is stuck between a range. So you have something like this. So that's a range, and price is stuck between a range, right? So generally, what I usually do is I avoid trading ranges, right? I avoid trading ranges. I love trading trending markets, either trending upward or downward. I generally stay out of ranging markets. So I'm going to simply delete this range, and we are going to talk about the case of a trending market, right? So let me take the case of an uptrend. The case of an uptrend. So let's say we have an uptrend, right? Now, to know the manner in which the market moves when you have an uptrend is very important, because you need to know when exactly you need to take your trades. It's true, we usually say that trade with a trend, but you need to know exactly when to take your trades, right? So I want to tell you guys that when you have an uptrend, the uptrend is always in the form of impulse correction, impulse correction, impulse correction, impulse, right? So it's always correcting to form the next impulse. It's always correcting to form the next impulse. So what do you see? You notice that for you to be able to capitalize on these movements, right, you need to buy at the end of the correction. At the end of the correction, meaning after the market has finished correcting, they need to look for your buy positions to the upside. After the market has finished correcting, they need to look for your buy positions to the upside. After the market has finished correcting, they need to look for your buy positions to the upside. Now, there are two main ways in which the market can move, right? There are two main ways in which the market can move. The first way is using straight up candles like this, using straight up candles with no retracement, right? Meaning you just have candles like this, bullish, bullish. Let me try to draw it. So you have straight up bullish candles like that. Then you have a bearish retracement like that. You try to, then you have a bearish retracement like that. Then you have the next bullish impulsive move, right? Which is from here upward. Let's keep that blue. So that's the next bullish move. The next bullish move. Then you have another bearish correction, right? from here, let me keep that bearish. So you have that. You have the correction. And then you have the next impulsive move to the upside. Right? So one thing you need to note is that the market can either move this way, right? Meaning with straight up candles, with no kind of like chart pattern formation around the corrections, right? It can move with straight up candles. And also one thing that the market can do is it can also move with it can move with corrections, what we call corrections or what we call pull counter trend corrections, right? So you can also move with what we call counter trend corrections. So I'm just simply going to delete all of this and I'm going to explain to you. So that was the first scenario when you have the market moving with straight up candles, right? Now, let me take the example of the market moving with counter trend corrections. So the market gives an impulsive move, then it does a correction like this. And I think you have already seen this on the graph, right? It does a correction like this, then it gives you the next impulsive move. Then it gives you a correction like this. Then it gives you the next impulsive move, right? So this is the second way in which the market can move, right? The first way in which the market can move is like this with straight up candles. And the second way in which the market can move is like this, meaning you have an impulsive move and you have a correction with a counter trend, right? And you have another impulsive move, and then you have a correction with a counter trend. So there are different ways in which you can trade both of these patterns, right? Both of these are uptrends, but you cannot trade them the same way, right? Both of these are uptrends, but you cannot trade them the same way. So the first case is when you have this, when you have straight up candles, right? When you have straight up candles, one thing you need to do is you need to look at some certain levels. You need to look at levels like this, right? You need to look at levels like this. Why am I looking at levels like this? Because it's an area that has been respected by price previously, right? It's an area that has been respected by price previously. Now, when price comes back to this level, right, we wait for a candlestick confirmation. Wait for a candlestick confirmation, which is usually a bullish engulfing candlestick, right? We wait for a candlestick confirmation. When you have a bullish engulfing candlestick, you are now good to take your buy positions. Remember, I'm talking about higher time frame analysis, right? I'm talking about higher time frame analysis. So you are watching all of this on the 4-hour time frame, right? So when you have something like this and the market comes back and reaches this level, you wait for a candlestick formation to form at this level, and then you take your buy, you continue with your buy position. Same thing happens when the market breaks this level and comes back to retest it. You wait for a candlestick formation and you continue with the buy positions, right? And one important thing to note about these levels is that it also acts as a form of break and retest, right? It also acts as a form of break and retest. You know the break and retest whereby the market breaks a level and it comes back to retest that level and continues the movement, right? Same thing, it breaks a level and it comes back to retest the level and it continues the movement. So that's just it. And another thing you need to note about this kind of entry is that when the market is retracing, right, the market can actually retrace up to here, right? The market can actually retrace up to here. Why? Because it has not yet violated the law of an uptrend. What's the law of an uptrend? The law of an uptrend simply says that the market should not break the lower high, right? The market should not break the higher lows, pardon. The market should not break the higher lows. And this is our higher low here. And the market has not broken any higher low. So if the market is anywhere between here and here, right? The market has not broken any higher low. You can still take your buy positions. But what are our emphasis? Our emphasis are at these levels, right? At this level and at this level. That's generally where we look for our candlestick confirmation. So we have two levels. You have this level up and you have this level down. So generally, you look for your candlestick confirmation there and you keep buying. So that's that for the first way to trade your uptrend, and that's that for the first kind of uptrend you have. And now for the second kind of uptrend you have, which is this, whereby the market moves in impulse correction, and during the correction, the market generally forms a counter trend, a form of counter trend, right? What we do here is that what we do here is that we wait for the counter trend to complete. We wait for the counter trend to change trend, right? We wait for the counter trend to change trend. So let me explain myself. Let me take, for example, this is the first impulsive move here, right? This impulsive move is our first move. Now we have a correction here, right? We have a correction here. How do we enter for the next impulsive move? For us to enter for the next impulsive move, we need to wait for this downtrend correction to change into an uptrend. And when do the downtrend correction change into an uptrend? It changes when the market breaks this high, this higher low, this lower high, pardon. It changes when the market breaks this level here. Why? Because this is the high that we are expecting to break for the market to change from downtrend to uptrend. So once a candle breaks this high here, we enter our buy positions and we are good to go for another buy, right? Same thing happens here. You see that we have an impulsive move. Now, you have a correction in the form of a counter trend, right? You have a correction in the form of a counter trend. What do you wait for? You wait for this counter trend to complete. You wait for this counter trend to be over. And when do you consider the counter trend to be over? When the market changes structure, meaning when the market breaks this high, right? So when one candle closes above this high, that's when we are good to go for buy opportunities again, right? That's why I'm good to go for buy opportunities again. So once a candlestick closes above this level, above this high here, we start looking for our buy positions. So that's how you go about identifying the two different types of uptrend. So you can either have straight up candles or you can have impulse and correction moves, right? Now the same thing applies to a downtrend, right? The same thing applies to a downtrend. Let me just flip my chart and explain the same thing for a downtrend. So now we have a downtrend, right? Now we have a downtrend. So you can see here that the market is making lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. So let's take for the first example, which we have straight up candles, straight up bearish and bullish candles, straight up bearish and bullish candles, right? When you have such situation, you use candlestick to confirm your next impulsive move, right? When you have this kind of situation, you use candlesticks to confirm your next impulsive move, and you don't use candlesticks at just any level, right? Remember, I told you use candlesticks at levels like this, simply because it's going to have more meaning. Why? Because it is also a break and retest level. So when you have a candlestick formation here, a bearish engulfing candlestick that happens here, then it is stronger. It is a stronger confirmation for the sales continuation, right? Same thing happens for this level here. You see that there is the impulsive move, and now there is a correction. Here, you wait for a candlestick confirmation to enter your sales to the downside. Same thing if the market could come to a level like this, right? If the market could come to a level like this, you know that at this level, you first of all had what? You had a break and retest here. You see the market break and it retested the level once, and then it went to the downside. So when the market come back to this level, there is more probability that it's going to shoot to the downside again. That's why I'm choosing this. That's why I consider this level an important level too, for us to confirm our trades, right? So if you have the market that is at this level and you have a candlestick confirmation here, then you can enter your sales, right? So that's that for the straight up bullish and bearish candlestick type of graph. And now let me just arrange this back here. And now when you have a bearish market structure whereby the market is doing impulse correction using a counter trend, then remember we need to wait for the counter trend to be over for us to continue selling, right? If we sell anyhow, then the market will keep on taking us out. The market will keep on taking us out, right? Here we cannot use candlestick confirmation. Why? Because here you see that if the market is doing a counter trend, right? Let's say the market gave us a bearish engulfing candlestick at this point here, right? Let's say the market gave us a bearish engulfing candlestick at this point. You try to take your sell, the market comes and stop you out, right? It gives you another bearish engulfing candlestick here. You try to take your sell, the market comes and stop you out. You try to take it gives you another bearish engulfing candlestick here. You try to take a sell, the market comes and stop you out. So the best way to do is you wait for the counter trend to be over, right? And how do you wait for the counter trend to be over? When the low is broken, right? when this low is going to be broken, when one candle will break below this low, then you know that okay, you are now good to go for sales. And once you see that, you can now try to enter your sell positions to the downside. Same thing happened for this order correction. So you have your counter trend, you wait for the market to break this low, and once the market breaks this low, you start looking for your sell positions to the downside. So that was that. So those are the main things I usually watch for when I'm trading on my higher time frame. I usually watch out if I am having straight up bullish and bearish candles, or I am having the form of impulse consolidation using counter trend. So those are the two main things that I usually watch for. And remember, we watch them on a trending market. We always want to see it on a trending market. We don't want to see things like this on a ranging market, right? We always want to trade a trending market. So those are the two main things I usually watch out for. So if I cannot identify this kind of patterns on the higher time frame, which is the 4 hour time frame, then I'm probably going to stay out of that market, right? I'm probably going to stay out of that market. So let me just try to give you an example and a simple scenario of what I'm talking about. So here, let's open to GBP AUD, right? Now, on GBP AUD, let me flip my chart. So now on GBP AUD, right? Let me just remove my drawings and explain to you everything. On GBP AUD, what can we see? On a higher time frame, you can clearly see that we are in a downtrend here, right? Just put this. So on the higher time frame, we're on the 4 hour time frame, right? We can clearly see that we are in a downtrend here. Let me just go to the daily time frame and check where we are at, right? So on a daily time frame, we are also in a downtrend, right? You can see that the market is basically in a downtrend on the daily time frame. So I'll go down to the 4 hour time frame. And on the 4 hour time frame, we are also in a downtrend, right? You can identify that this is a downtrend simply because you have here, you created this low, created this high, lower low, lower high, lower low, and it's about to make another lower high, right? So here we consider this a downtrend. So remember, we said that there are two main things that we want to see, right? We want to either see that the market is giving us this pattern, straight up candles, or we want to see whether the market is giving us this other pattern where you have a bearish, then you have a retrace in the form of a consolidation, then another impulsive to the downside, then consolidation, then another impulsive move, right? So we want to see whether the market is giving us this kind of pattern or it is giving us this kind of pattern. Now, when you look at this market here, right? When you look at this market here, you clearly see that we are in a downtrend, right? You clearly see that we are in a downtrend, and we can clearly identify that this is our lower high. This is our lower high. This is our lower low. This is our lower high here. This is another lower high here. And this is the lower low here. Now we are waiting to see the manner in which the market is going to retrace here in order for us to take our sell position, right? We are waiting to see the manner in which the market is going to retrace in order for us to continue with our sell positions. So we look at what the market did. Look at what the market did here. The market retraced, forming a counter trend, right? If you look at the market very well, it was forming an uptrend here. And remember what I said, when the market retraces using a counter trend, what do? You wait for the counter trend to be over, right? You wait for the counter trend to be over for you to take your positions. So here you see that the market was making a counter trend. So what I simply did is I waited for this counter trend to be over, right? By simply waiting for the break of this level, right? You see that the market, let me see if I can draw it here so that you see well. So you see that the market did this. did this, came down here. Sorry, let me remove this. So the market did this, which is basically an uptrend, right? Which is basically an uptrend. So what was I waiting for? I was simply waiting for the market to break this level. And what happened? Look at this bearish candle that broke this level. After this bearish candle came and broke this level, I knew that, okay, I'm good to take my sell positions. So what do? I simply wait for the market to give me a sell entry, right? I simply wait for the market to give me a sell entry. So I went down to my lower time frame, which is the 30 minutes. I generally like to take my entries on the 30 minutes, sometimes on the 15 minutes, but it generally depends, right? So I go to my 15 minutes and look at what happened. Here, at this point, this is where the candlestick broke. This is where the candlestick broke our uptrend, our counter trend, right? This is where the candlestick broke our counter trend. So here, I was simply waiting for the market for one candlestick to close above this range. Because if you look at here, the market was making a range. The market was in a range here, right? The market was in a range. So I was simply waiting for one candlestick to break below this range to confirm my sells, right? So once this candle broke below this range, I entered my sell positions. I entered my short positions. And my stop loss was simply above this range here, right? My stop loss is simply above this range, and my take profit is all the way to the downside here. My take profit is all the way to the downside. Why is my take profit down here? Simply because we remember that once the market has finished correcting, the market goes back to it goes back to continue the range, right? So here we already noticed that, okay, the market has finished correcting. So we are expecting the market to continue to the downside until at least this point, right? So our take profit is at this point. And that's that for the trade. And we are going to let the trade run and we are going to see. So I'm going to update you guys on how the trade goes. And yeah, definitely, this is a risk reward of 1:2, right? Almost 1:2, 1:1.9. That's almost 1:2. So that's how I took this trade, and it was simply using that concept, the concept of higher time frame analysis and market structure, trends. That's, in fact, it's simply understanding how the trend moves, understanding the different ways in which a trend can retrace, be it by straight up candles or by counter trends, and then capitalizing on any of those scenarios, whether you're having a counter trend or you're having a straight up candles, whether you're having straight up candles or you're having counter trend retracement. You need to know how to capitalize on them, and that's how I simply did to take this trade. So that's it, and I'm going to update you guys on how the trade goes, right? You can already see that the trade gave us our first impulsive move to the downside, and it's still correcting, and hopefully we are expecting another impulsive move to the take profit. So that's that.